Uh, Okay, good afternoon, everyone, and thank you for joining us. On behalf of Acclime, I'm pleased to welcome you to today's webinar. We're especially delighted to be joined today by Didier Magloire, who brings a wealth of experience as the former Global Head of Country Risk Management at ANZ Bank. In that role, Didier was responsible for assessing how much exposure a company should take in any given country. And that was kind of a position that really required a deep engagement with economic data and risk analysis. So today he's going to be sharing some of those insights with us. Just before we begin, a quick introduction to Acclime. We're a leading provider of corporate services in the Asia Pacific region. We're now present in 17 markets with over 1,800 professionals across the region. We support more than 13,000 clients globally, helping them navigate pretty complex regulatory environments and to just generally operate more effectively in their chosen markets. So really, whether it's market entry or accounting, tax compliance, or operational support, we help businesses thrive in these more complex markets. So without further ado, let's get started with our webinar. Pass you over to Didier. Didier, take it away.
Can you hear me, Jacob?
Yes, we can hear you.
Great. Thank you. Thanks for the invitation, Jacob, and your colleagues, and for arranging this. I look forward to spending an hour or so with you and your guest talking about the economy in China. As you said, I was country risk manager for ANZ. Also, more recently, I was the chief risk officer for the bank in China, where I'm still based in Shanghai right now. So I've been following China very carefully for the last 10, 15 years, and from in country for the last 6 years. I think it's a fascinating place, and what's happening in the economy is it's history in the making. We get to watch history in the making right now. I studied economics. I have a master's degree in economics from New York University. However, what I'm sharing with you is not an economist's view, but rather a practitioner. So I use this data to formulate a view for myself, to help advise my clients on how to manage their China risk and do business in the country. And so please keep that in mind. I'm sharing with you my views and what I see. If you go to the next page, today we're going to cover a few topics, right? We'll look at the macro economy and the GDP performance and things like that. We'll drill down a little bit into trade and industrial trends, and then talk about FDI, foreign direct investments, and capital flows through the financial markets. We'll talk a bit about policies, business implications, and a bit of my observations around how the market is changing in China, in particular, how consumers are behaving very differently. Many different topics. We have enough time to cover it all. I encourage you to ask questions, and I encourage you to share your thoughts on what you're seeing also and what you're thinking. So if you have a question, please type it into the box, and Jacob will work with me. We'll cover the questions as we go along as much as possible. If we can't cover them, we'll cover them at the end. First to start, let's go to page 3, Jacob. I still see the cover page, and talk about macroeconomics. China set a GDP growth target of 5% for the last few years, and they've more or less hit the target quite consistently. How they get there is different every year. It changes over time. And as you know, the target used to be much higher than 5%. I think for an economy this size, that number is reasonable. And in some cases, we'll see today that it's quite a stretch and a challenge to meet that target, that number, in some cases. But just to share the statistics with you, right? The performance more recently in March, as of March, is still pointing to 5%. There was already some distortion there in the numbers, meaning that people were reacting to tariffs and front loading some orders in the beginning of the quarter, cutting back and almost freezing towards the end of the quarter, spilling into April and May. So the numbers are very volatile in the first quarter, and it'll be the same in the second quarter. However, on average, most firms are still predicting 5% or a bit less for the full year. Price index, consumer price index is something to watch. There's a slight, the consumer price index is slightly positive, but there are deflationary pressures in a lot of sectors and price competition in a lot of for many products. So what I expect you'll see going forward is that inflation will not be very strong, and you may have some issues where deflation becomes an issue in some sectors. On page 4, we have, to wrap up on the macroeconomic, I've made some of these points already. Service sector is doing quite well. There are deflationary pressures in some industrial sectors. Property remains a drag on the economy in general. It's flatlining, starting to stabilize, but it's still a drag. And the government is flexing more and more, both on fiscal and monetary side, to put a floor on how low the economy can go. So the outlook for 2025, as I said, at the macro level is quite stable. Headwinds are stronger, but my prediction is that they will meet their targets, but with a lot of volatility and a lot of structural changes below the number. We'll get into that when we move to the other topics. Talk about trade a little bit. In this graph, the number stands out a lot in February. You can see that both import and exports shot up compared to the normal average. And this is what I was referring to before, where people were anticipating tariffs and were front-loading and rushing to ship anything that they were buying or selling as soon as possible before the tariffs kick in. All in all, China had a very good year from an import-export point of view in 2024, and the trade surplus was $1 trillion for the full year. The exports were up about 4.8%, and imports were down 3.4%. Because of the tariffs, I want to share some thoughts on this with you. The tariffs will have an impact on China, and they will have an impact on other countries that are affected by this. The magnitude of the impact is debatable, though. One reason for that is, I'll share 2 numbers with you. China's economy is quite big, and it's still export dependent, but all in all, exports represent about 20% of the Chinese GDP. A country like Vietnam, that number is north of 50% in other countries. So while the number is big as a percentage of the economy, it's manageable. That's the total. And exports to US is about 2.5% of that GDP. So from a macroeconomic point of view, as a policy director in the government, you can see why China is negotiating the way they are, the way they're not making concessions quickly, but they're negotiating, because ultimately 2.5% of your GDP is an important number, but it's not a fatal number. I just want to put that out there. What that means, tariffs, what it means for specific sectors and for specific companies can be quite material, but for the economy as a whole, it's manageable. So that's why a lot of economists are making predictions for GDP growth for the full year that are the same or slightly lower, not noticeably lower, just slightly lower than before the tariffs kicked in. I won't spend too much time on the next page, but it's for your information. I was able to get some statistics on the breakdown of the biggest items that are imported and exported by sector. It matters to you if you're in these sectors. The numbers are what they are. Another gauge of, if we go back to the other page, back to page 7, another gauge of economic activity is around PMI, Purchasing Managers Index. The way this number is measured, for those of you who don't use it often, it's designed in a way where a number below 50 suggests that the activity that it measures, the purchasing managers of factory goods and things like that, will reduce. A number above 50 predicts that it's going to increase. So if you look at the graphs carefully, the top one is around manufacturing, the bottom one is for non-manufacturing activity. They're hovering. It looks quite dramatic, but if you scale properly on the graph, you'll see that they're hovering around the 50%. The 50 number. It's not a percentage, it's just an absolute number, the 50 number. So what that says is, if you this suggests that the economy will continue moving sideways, no strong growth, but no material collapse predicted, both in manufacturing and non-manufacturing sector. One thing to keep in mind is government flexibility and their ability to support the economy with monetary policy and with fiscal policy. On this page, we're looking at fiscal policy, so government deficits and the ability to run a deficit to support the economy when others are not spending enough, the government will spend and prop up the GDP numbers and prop up certain sectors. And what you can see here is that over time, long before tariffs came and other factors, the government is spending more and more money as a percentage of GDP, and in absolute terms, they've been spending more, as you would expect, as the economy develops and the economy becomes more complicated. I won't go into too much detail here, but what the blue versus the red line shows are different ways of measuring government spending. In China, there are 5 different ways they measure government spending. This is highlighting 2 of the most obvious ways. One is just the government deficit, whereas the other one with the red would include pensions and other off-balance sheet type items, but are still government spending. The key point to take away here is that the spending as a percentage of GDP is going up, as you would expect, as it should, in order to support and put a floor on the downward trend of the economy. If you have any questions on this, we can come back to it later. Moving on to page number 9, I wanted to talk a little bit about financial flows. I think this may be quite relevant to the audience here. A lot of you doing business across borders into China and out of China. Financial investments, right? So this is money coming into the share market, into the fixed income market, actual dollars and other foreign currencies coming into the country has been on a steady increase. The government has been quite supportive in putting in new schemes. The most obvious ones are Hong Kong direct type schemes, many different Hong Kong linkages in order, depending on the type of financial investment you want to do. But there's also other ways where you can bring money in, and also other ways where Chinese can invest out. Most people think it's quite difficult, but there are ways where Chinese institutions and Chinese individuals can invest offshore. What you'll see on this page, which is noteworthy, is the sudden drop in 2025, and that I attribute again to the news around President Trump getting elected and some uncertainty that's put a damper on these movements. If you look at 2024 in aggregate, the financial flows were quite healthy, and most of them were pointing up on a year-on-year basis until the election and trade frictions started again. The picture for FDI, which is the next graph, FDI is different, right? FDI, the simple definition, the simple example would be companies building factories or buying property or doing things like that, as opposed to financial investments into China. FDI has slowed year on year. On this page, we show early 2025 and 2024 statistics, but I know from watching it that it's been going down in 2023 also. So there's been a consistent slowdown in the amount of money that foreign companies are putting into China. This is explainable by the decoupling that was going on for many years. So China plus one, or these types of strategies, or China for China, all those strategies would point to less foreign direct investment because there's less need to build in China. So what companies are doing is what they have, they maintain. Some pay more dividends than usual, but they keep assets and they keep money in China to run a China-type business, but they're not sending in more new money in. That's what the aggregate numbers suggest. Now, from talking to people in the different sectors, including people who do mergers and acquisitions and help companies, for everything I say, you can find an exception. Biomedical, in particular, pharmaceutical, I think is quite strong, where there are a lot of companies doing acquisitions in China and trying to build a portfolio of assets and licenses and approved products in China, because it's a huge market and it's only set to grow in the medical field, for example. So what this FDI number shows in aggregate is that there's a slowdown, but depending on what sector you're in, you might see a trend that's quite different than what this average is showing. Another way to look at activity in the economy is around loan growth. And in China, excuse me, in China, loan growth matters a lot because the banking system is relatively large. So the banking system plays a disproportionate role in supporting the economy. I have a separate talk that I do on that. I won't go into more detail, but the proportion, if you look at the way the Chinese economy funds itself, and you think about loans from banks, you think about bonds, you think about share issuance, you think about private equity. There are many, many different ways an economy or a company can raise money to grow. The loan growth, the banking sector is disproportionately big for an economy of this size. So when you look at the loan growth, you get a very good prism into how the economy is doing. And what this is showing you is that throughout the year, the last 12 months or so in China, loan growth has diminished quite noticeably. There's not much demand for new money, even though the government is trying to promote it. And this is what this next page shows. What this next page shows us is the rate at which you can borrow money. So it's the loan prime rate. Many countries have a very similar concept. It's the rate that your best clients can get plus a margin, right? So as the prime rate goes down, companies like yours actually can borrow more cheaply. And what the government and the regulators, the banking regulators, have done quite consistently, not only in 2024, but this graph goes back to 2023 and earlier, is they've been very slowly but surely chipping away at the margin that banks can earn. So the net interest margin that a bank earns is smaller and smaller, less money for the banks, more money for the benefit of the economy. That's the strategy that they're pursuing. That they're pursuing here. However, if you remember the page before, the demand for the loans, even though loans are cheaper now, the demand is weakening because people are just not building factories or piling on inventory as much as they used to. That's what this macro data is telling us. Moving on to the next page, we take another quick look at Purchasing Managers Index. We talked about it earlier. Again, I won't spend too much time on it. Again, it's hovering around the 50 range, which suggests moving sideways. It's becoming more volatile, but still in the 50 range. And I expect that the volatility will increase now with structural changes, competition going on in the economy, and people positioning themselves for the next wave of tariffs, tariff agreements, or tariff retaliation, depending on which way the wind blows. This graph here looks at a more granular direction around import and exports. And you can see the drop in exports that have been, let me be more specific. It's comparing the trade war, the first version, which was 4 or 5 years ago when Trump was president, to this version. So the orange line is the more recent trend. And what the story is here is it's showing you how more dramatic this trade war is in impacting the volume of trade compared to the first time. As I said earlier, I do want to point out that you can't see it in this graph, but the volume of business with China-US volume has decreased noticeably over the last 5+ years, which puts China in a good position now to negotiate, as I said earlier. So the dependency on trade with US is decreasing. This is not the topic for today, but I'll share with you my thoughts on this quickly. Because of the way Trump is managing this and putting tariffs on a lot of other countries, almost everyone is trying to figure out how to do business without selling to the US. So there's a strong trend of how do we sell to each other and less to the US. It's the opposite. So the importance of the US as a trading partner, I predict over the next 5 years will decrease even after the regime changes. This trend, I believe, is quite strong, and it's probably not going to reverse anytime soon. One last thought around consumers and behavior. I don't have much statistics on this, but this information I've gathered from speaking with people in different sectors and speaking with other people like myself who follow the economic data even more carefully. There's a very strong trend, and I think some of you know this. Chinese consumers specifically and Chinese companies also are being more careful, right? The loan growth, for example, is so anemic because people are being more careful on borrowing money and growing. And the point I'm making here on this last slide is that the consumers have changed their behavior in a way that's quite noticeable. It's impacting luxury brands, it's impacting automobiles, it's impacting travel, it's impacting catering and food and beverage. It's impacting a lot of sectors. The overarching trend is people are being more careful with their money. I can tell you, for example, travel. We tracked travel during COVID. As you would expect, it collapsed because it was not safe to travel. However, when the volume started to pick up after COVID, there was already a noticeable change. So this is not about sanctions and tariffs. It's a more persistent trend around people being basically a bit smarter with how they spend their money. So what we noticed back then when we were watching this for ANZ China is that the volume of travel was increasing, but the spend was less. So the amount per trip was a lot less, and it's becoming stronger now. I recently read an article where in Hong Kong, the luxury goods sellers are not doing well because a lot of visitors from mainland visit China, visit Hong Kong, spend some time. They don't really shop a lot like they used to, and they, you know, they go back with some nice pictures and souvenirs, but not a lot of luxury products in their hands. So this is showing up in experiences. People are putting more value on experiences as opposed to buying material things. This is showing up in wellness, buying more healthy food, more gym memberships, and less conspicuous consumption, right? Conspicuous consumption is, hey, I have some money, I'm spending it, and I want you to know this. I want you to know that I'm spending all this money. Whereas now people are spending more money, they're spending less, and they're choosing to spend it on themselves in a more healthy, premium way. Fewer goods, premium items. It's a very strong trend, and I think that it will continue for the years to come. It's a permanent change in how Chinese consumers behave. With that, I'm going to pause here and see if we have any questions.
No questions so far, Didier, but you're doing a great job.
Thank you.
We'll look forward to you continuing.
Well, it's a bit of a challenge to continue. I've kind of covered all my topics. We can maybe finish early if there are no questions or comments from the audience. I was hoping that there would be some questions or also some observations from people on the ground who are in specific sectors. The challenge with looking at economic statistic is you use a lot of averages, and the averages sometimes can hide a story that's even more interesting than what's really happening. That's why I put the last page there on there, because the macroeconomic and the high level numbers tell a story, but there's actually more interesting stories that are taking place in specific regions or in specific sectors that create opportunities and to some extent some threats also, right? So you need to know these details. Let me go ahead, Jacob.
No, I just wanted to thank you for providing such a sharp and data-driven overview. I think it's kind of important to highlight those key trends in like GDP growth, inflation, consumer behavior. It's sort of good that you cut through some of the noise on it as well. I mean, for me, I think the persistent deflationary pressures in the industrial sector.
Yeah.
Oh, we're getting a question. Okay.
Okay.
Where will US companies relocate to? Sorry, I'm just about to read out a question we've received from a guest in the audience.
Yes,
where
please.
will US companies relocate to if not manufacturing in China?
It's a very good question. I don't have a clear answer to that. I can tell you that Vietnam was a beneficiary over the last 5+ years. So there are a lot of multinationals that have put billions of dollars into Vietnam. It's for obviously good reasons, right? It has some of the same stability that you see in China in the policies.
Yeah.
It's quite user-friendly. I don't think it's as good as China, but it still welcomes foreign investment. However, they've kind of painted themselves into a corner. They have a situation, as I pointed out earlier, where their dependence on export is massively larger. Their trade surplus with US is big as a percentage and in absolute terms. So they're now a target. So if you move your factory, even Chinese companies, not multinationals, but even Chinese companies that I used to cover, they themselves would pick Vietnam as the next place to invest in order to circumvent. Vietnam and Mexico are the two ones that get called out the most. as a way to finish your products in another country and then ship to the US. However, Vietnam is getting hit with sanctions. So in Asia, a lot of the countries that I hear people mentioning are India, Bangladesh to some extent for textile, and maybe some other countries where the tariffs, excuse me, where the trade surplus is lower, so the tariffs are lower.
Yeah, I think it's kind of indicative of China moving well up the value chain. So I think items and products that are sort of medium to high up that value chain are going to still be produced in China for the foreseeable. It's that kind of marshalling of capital, people. Yeah, it's all able to be marshaled rather quickly. So I think that's one of the key advantages of China still, as opposed to ASEAN. Yeah, I mean, I think it was interesting how you pointed out the sort of steady shift in consumer behavior as well. Driven by things like urbanization. I think you said digitalization, and then the kind of premiumization of the economy here, and those experiential sectors getting a real boost because of that. I thought that was a really good point.
There's a Chinese word, the national pride, right?
Guochao.
Guochao. That's an interesting one, right? Because when I moved here 6 years ago, but I've been following China even longer. Foreign goods were considered premium, and they still are in some cases. However, there's a phenomenon now. It started in I think in retail and luxury goods, but it's spreading. It's certainly happening in autos. Let's talk about that next. Where the Chinese product is as good as the foreign one. And the Chinese product, the Chinese individuals are very proud and happy to buy their own product compared to the foreign goods. So that's a natural evolution. It's something that I myself, I buy the Chinese products also. I'm happy to do that. I think it's great. I can remember, Jacob, when I first arrived here, when I ordered a DD, I was very happy when the car showed up and it's a Volkswagen. Right? I was a bit disappointed if I got a Chinese automobile. That was just 5 years ago.
I remember. Yeah.
Now it's completely reversed. I think if you've been here long enough, it's completely reversed. I'm so happy if I get a Chinese car to pick me up because they're bigger, more spacious, more quiet. It's just amazing how fast the quality of the products have improved, and so this will not change.
I think it's flowed from sort of top down, isn't it? There's been a policy focus on high quality growth through fiscal stimulus and support for those kind of strategic sectors. I know EVs, the government released a white paper back in 2010, pretty much laying out the roadmap for how they were going to reach it. And within 10 years, they'd achieved it. So,
yeah. Yes. And the products, especially for consumer products, people will not buy unless they really want the product and they like it, right? So you can make all the cars you want, but if they're not as attractive or as practical or as sleek as you want them to be, people won't buy them.
Yeah, the Chinese consumer has become a lot more discerning.
Exactly.
Even people who have access to money, they're looking for value above all else now. I think, yes. As you said, gone are the days of the sort of wasteful, frivolous spending. It's all about value creation now and getting the best
value creation,
the best bang for your buck.
Agree. It's quite noticeable in the auto sector. The number of automobiles sold in China has decreased year on year for the last 2-3 years. So it's a shrinking market. People just don't need automobiles as much as they used to. However, if you look at the sales volume of European brands, down 20, 30, some 50%, versus sales volume for certain Chinese brands up the same percentage, it's quite dramatic. So here's an example of what we're talking about on this page, right? The shifts in consumer behavior are very, very dramatic, and you need to look at the details and educate yourself on what's going on in these. Because if you look at an auto market where the number of automobiles sold decreases a little bit every year, it's challenging, right? However, some of them are able to still get 20, 30% growth rates in a shrinking market. So that, I think, as an economist, as a guy who follows the market, I think it's just fascinating to see such dramatic changes occurring as the months go by.
Yeah, agreed. Well, I think I really appreciate you being able to cut through the noise, and I think you've presented the risks and the resilience. You've been able to sort of present both the risks and also ways to become more resilient in this kind of changing economy now. So I thank you for your time and for sharing those insights with us. Really appreciate
Thank you.
it. Great.
The
Well,
last
thank you.
contact information. I think the audience is a bit shy, but if you have any questions or comments and like to have a follow-up conversation, please reach out, and I'm happy to discuss with you. Because the key message is the headline numbers matter; they're quite interesting, but the devil is in the details. It's all the details will change depending on what sectors you're looking at, and that's where the opportunities and the threats are.
Yeah, agreed. Well, thank you once again, Didier, for sharing your insights and your experience and helping us all to navigate the complexities of China's economic landscape a bit better. We really appreciate it.
My pleasure. Thank you very much for the invitation.
My pleasure. Okay, everybody, great. Well, thank you very, very much for attending today. If you would like a copy of the PPT slides, we would be happy to distribute them to you afterwards. Just drop us an email and we'd be happy to share those with you. Thank you, everybody. Great. Have a great afternoon. Bye-bye now.